Hey, good morning, everybody. It's Friday, May 15th, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products to help my originator friends get business from Google and social media and AI search. Products like Originator Success, Grab and Go Social, and Rate Sensei. Three great products. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, where I usually like to bring you better news. This morning is a sad, sad day. Rate sheets are going to be blasted this morning. We'll talk about why in a minute and give you all the details. Remember, if you're here this morning, say good morning. If you want to join me and not miss a moment of the show, make sure you get our text reminders with the links at hmmr.io/reminder. You sign up. We don't use your cell number for any nefarious purpose. It's just send you that morning message so you can join me. You can also use this QR code over here. Sign up for our Rate Lock Advice, the email that hits your inbox each and every weekday morning at ratelockadvice.com. And you can sign up for our text alerts at ratetextalerts.com if that interests you as well. So if you're here this morning, say good morning. If you're watching the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Let's go ahead and welcome all the live folks. We'll jump in and get started in 14 seconds. Good morning, Vicky McSweeney, Mike Tebow. Loans with Mo. Who is Mo? Help me again. Who is Mo? Loans with Mo? That's all I see, but I forgot. Is it Maureen? Is it Maureen? I think. Holly Johnson, Mike Schmogan, Rob Wilson, Jared, Vincent, Randy Teakle, Kathy Jensen. Good morning, giddy up, y'all. Hope y'all are having a at least a good morning, although you're not going to want to go ahead and look at your rate sheets. You're not going to want to turn on your computer. So, Jerry Avila, good to see you, sir. Let's go ahead and get started. I'm going to fire it up here. Let's start off with our technicals. We'll take a look at the technicals here, and you will see that this morning mortgage-backed securities are getting slammed. Let's take a look at the 5.0 coupon. I'm going to switch to the 5.5, for heading into next week at this point. So the 5.0 coupon currently down 54 basis points this morning. The 5.5 currently down 37 basis points. At that point, you're majoring in the minors. It doesn't really matter what level they're at. We're just getting absolutely slammed this morning. You could see that it started with we had overnight losses here. So we were already down quite a bit. We ended yesterday at 100.22, started off this morning 100.3. So we were down about 20 basis points. And then at 820, you see that 820 is when we have when our domestic markets open. And you could see that since then, everything has just fallen apart even more. We're seeing more of a sell-off. What this generally means is that we would see at least some kind of recovery maybe on Monday, but it's not something that we can bet on. And we'll talk more about that in a minute. Let's do a quick recap on what happened yesterday. Yesterday was not a terrible day, but pricing came out. Pricing comes out around 10 a.m. Let me make this a little bit smaller so you can see 10 a.m. So 10 a.m. is right here, right? So pricing comes out around 10 a.m. And up through the early afternoon, it was basically flat on the day. We didn't see much movement, but then through the afternoon, we see bonds that just kind of are drifting lower and selling off. And there was no clear reason for this. There was no, nothing to really point to say this is what's causing it. It kind of shows that was where things were headed and why they were headed that way. And it was a lot of that has to do with, man, this just gets on there. Sorry, guys. I had it lined up and then moved. A lot of that had to do with, you could see where trading was going. This is not just, our mortgage-backed securities or even our treasuries. This morning, the 10-year treasury, 4.57, even if we want to just pretend we don't hear and we say 4.56, it's absolutely positively gross. You could see this big jump right here where we ended the day yesterday and where it jumped up to today. Big jump in 10-year treasury. Rate sheets today are going to be worse, much, much, much worse. you're not going to want to look at pricing this morning. Anything that you quote, I mean, again, we've been in a locking stance the last couple of days, except for anything closing longer term out. In our text alerts yesterday, we talked about locking. We've been in a lock stance because the writing is on the wall. There's no optimism. All this drama over in Iran is continuing to drag on and on and on. Markets yesterday were a little bit excited about what was coming out of China, the headlines out of China. But then that kind of fizzled and that optimism disappeared, and we weren't seeing things going nearly as well. So good morning, Brandy Brickler and Jerry Avila, Dino Clathis, Tim Halverson, Monica Dinkins. Thank you, Monica. I got to write that down because I always forget who has which handle, but Monica Dinkins. I knew you. I can't see your picture, that little tiny thing though. So anyway, rate sheets today going to be much, much, much worse. Reprice risk today is high. What's happening is we're already seeing bonds taking a big sell-off. If you take a look here, so it's not going to take much for things to continue to get worse. So they're finding a bottom at the moment right now, but we absolutely could see more what we call snowball selling. When you're down 36 or 50 basis points, notice, by the way, that watch this, right? So the 5.0 coupon is down 51 basis points. The 5.5 is down 36. The 6.0 is down 21, right? It's half of what the 5.0 is. And I can't go higher. I think you can if you have a different plan. But if you were to continue to go higher, the losses would be lower because people are moving. What you're seeing is investors, traders, they're moving into higher coupons on everything. So that's why we're seeing that. One thing I don't talk about a lot, which bears talking about today, is when we are seeing, bond yields go this high, one of the big problems here is the borrowing costs. We fund so much of our government on borrowing, and our borrowing costs and to service that debt is getting more and more expensive. And it's one of the reasons that Trump beats the drum that he wants the Fed to lower the Fed funds rate, is because it would help drive down some of the other borrowing costs. But the reality is this is a problem because we are borrowing, we're constantly borrowing money, and it's getting more and more expensive to do so. And that's going to put us deeper and deeper and deeper in debt. And it means we need to borrow even more, which drives it up. And it's a cycle. So this is all bad stuff. Now, one thing that could happen later in the year, I think we have a pretty strong shot of seeing a recession right now. I'm not seeing it mentioned in the headlines. It's just me personally. One of the things that would argue against that is spending, like yesterday's retail spending numbers. But when you dug apart the retail spending numbers, people are spending more money on gas, more money on the things that they need. Like, for example, services now starting to add fuel surcharges. Are you guys seeing that? Let me know in the comments. Are you seeing fuel surcharges on anything? I am. I'm starting to see fuel surcharges show up. And that means, everything else gets more expensive. If you don't see fuel surcharges show up, you may just see prices go up or the quantity of packaging, et cetera, go down. All of this is inflationary. This is a global problem. And that's part of the reason why this is so becoming such a big deal, right? So right here, global bond sell-off. This is not just mortgage-backed securities, not just our stuff here, our treasuries. This is everywhere. Investors shed government bonds around the world, propelling costs to multi-year highs from Japan to the U.S. amid intensifying fears that war-driven inflation will force central banks to pursue higher interest rates. And remember something, this whole conflict with Iran that the U.S. has been involved in, it's not just a U.S. problem. We made it a world problem because the Strait of Hormuz and oil not getting out, and oil being at Brent crude, I think, is at 108 this morning. But 30-year Treasury yield tops 5.1%, highest in nearly a year. And this is all bad. This points to next week being bad. We may see a little bit of recovery on Monday, but I think it'll dry up very quickly. I think we're going to see rates hit a new worst level of high. So keep that in mind. Jerry said, good thing I have 45 days to close on one deal. And let's talk about that. So that's the that's the that's the only thing that we can hope for is things that are closing at the end of June and into July. We can hope that something gets done with progress with the Strait of Hormuz and with Iran. It's the only thing it's going to drive that's going to drive rates down. We'll see rates stop going up a little bit and a day of recovery and everything else, but overall, you look at what we've seen, and we're seeing rates that have moved, significantly higher from this low point in April. And remember, April 7th was the ceasefire. So you could see that after that ceasefire was announced, we saw bonds, we saw rates improve. So this right here, this downward trend in rates where rates improved, that was after the ceasefire was announced, when we had all the optimism that something was going to get done, and with with Iran and the Strait of Hormuz and everything else. Since then, it's been very rocky. But I mean, look at this. We've gone, we definitely have moved up. And this morning, we will be up this way. We will be up this high. So we are definitely pushing up. And I warned yesterday that was what was generally looking like what was going to happen. But we've seen it move higher. And that's because there's no progress and there's no opening at the Strait of Hormuz. Oil continues to get expensive. Reserves, not for the US, but around the world, reserves are becoming an issue. And oil is running out, and that's it's going to be a problem. So tariff truce extension didn't come up in talks, Trump says. So Trump says he didn't discuss extending the tariff truce with Xi Jinping. Tariffs are the other thing that was a big part of what was being talked about in China. The fact that they didn't do something here and there was no announcement, that's one of the reasons why bonds are worse today. Traders, they want to see that costs are going down, that things are getting better. Trump to decide soon on Taiwan arms sale, non-committal to Xi Jinping about us selling arms to Taiwan. I don't know why we're really involved in that. I really don't. But that's just me. I'm just a dumb redneck in the Appalachian Mountains. So anyway, looking at this stuff, there was not really anything that the traders felt excited about with coming out of the whole summit with China. We didn't see any talk of, tariffs being removed or reduced, or, the extension coming up here. A lot of kumbaya stuff. Xi Jinping hailed landmark summit, saying many outcomes were achieved. But when you look at that, people were like, well, kind of what were the outcomes? Oh, great, you're shaking hands, woohoo. But what were they? Two countries reached an important consensus on maintaining stable economic and trade relations, but they didn't do anything. They just said they're going to do things, right? So this is all stuff that's really laying the groundwork. There's no reason to see bonds continue to improve from here. So, but here we are, 4.58 now. We're continuing to see the 10-year Treasury yield just worsen as we watch. Looking at mortgage-backed securities, the 5.5 coupon down 40 basis points, the 5.0 coupon down almost 60 at this point. And like I said, I think we have a really unfortunate chance of seeing things continue to get worse. Today's a day where you throw your drink of choice and we start to move on. These are the numbers that are going to shake things up and put borrowers on the sideline. Borrowers have been acting in the meantime with the rates in the low sixes. Now we're pushing up into the high sixes, and we're talking about sevens again, especially with loan level price adjustments. So this is all rough stuff. Jerry said, yeah, the end to this is going to be critical. If not, we will see it all drag on and drag us. Yeah. And the longer it drags on, it's going to cause rates to move up higher now. But I think it creates an even higher likelihood that we see a recession and rates improve towards the end of the year. And again, this is some political commentary, but we already know Trump is going to stamp his feet and demand that, Kevin Warsh convince everybody to cut the Fed funds rate. Let's remember something. Kevin Warsh can't cut the rate. Kevin Warsh is just one vote on the committee. However, he is likely to be voted as Fed chair. And that's actually voted on by the committee, not by Trump. Trump can't make him the committee chair. He can make him the Fed chair, but he can't make him the committee chair. But he will be the committee chair. It's just kind of what they do. But, the expectations of rate cuts, I mean, look at this, June, July, August, look at how much higher the expectation. It's growing. I mean, a week ago, there was no expectation of a rate hike. And yesterday it was a little over 10%. Today it's almost 20% as soon as September. October, they're calling for, I mean, look at this. Calling every rate hikes are rising across the board. By the time you get to December, it's let's put this on current just so you can see. They're looking at a 50% chance that rates will be the same at the end of the year, and basically a 50% chance that we will see at least a quarter point rate hike. You will not see talk of rate cuts until we see extremely weak labor data and or inflation comes down and or we hit a recession. If we hit a clear cut recession, then they will have to take some action on that. But I mean, how does Kevin Warsh have anything to try to convince everybody that they should be cutting rates when inflation is a problem? The reason the Fed raised rates to begin with was to quash inflation. The current conditions that have been created put us in a position where we would see higher rates, not lower. Until that turns around, mortgage rates aren't necessarily going to move down. And again, mortgage rates don't just have to be influenced by the Fed funds rate, but everything that comes into why the Fed raises rates is why mortgage rates go higher. Higher inflation, stronger economy, borrowing costs, are going to be higher. So all of this is why we're seeing that. So it's not good, y'all. We just can't seem to catch a break. Get out there and prospect. Do what you can do, my friends, is all I can tell you. So that is it. That said, again, to be clear, I'm in a locking stance on everything right now. It's just because I think we can continue to see things get worse. And let me just put that on the bottom of the screen. Lock it all. I'm going to say lock it all if you can. So it is just, we have seen such a turn in the last couple of days, and you could really see it. Let me put the mortgage-backed securities back on the screen. Hold on a minute. Doobie-doobie-doo. Here you go. Do that. Yeah. So, I mean, we have really seen, look at this. We went from last Friday, 98.90 on the 5.0 coupon, down to 97.59. So we're 130 basis points worse on that 5.0 coupon. And if we look at the 5.5, Friday we were at 100.81, this morning 99.82. So we were 100 basis points lower this week. That drives rates up a quarter to 3/8 of a point in rate, and that's what we're likely to see here. We went from 6.42 to today. You'll definitely be at 6.6 something, maybe even 6.7 something. So, I generally 6.52 is where we ended yesterday. So today, I think you'd be at like 6.71. You'll see a big jump, but at least 6.68, 6.67 is what'll show up on here later when they're pricing. The worst pricing we got on March 27th, what was that? 6.64? Yeah, 6.64. So we would be at like 6.65. We'll be right up there. It'll be bad. Did I ever see Quigley down under? I didn't, and I don't know what that is. Does anyone else know what it is? Randy's funny. Come on, don't sugarcoat it. If it's bad, just tell us. Yeah, Michael Garcia, it definitely looks gross. Mike Tebow, what caused the big drop? Nothing got worse in Iran. It's dragging on. It's them speculating the cumulative cost on what this is actually taking and what it's doing. It's also recognizing other countries are hitting extreme low levels of oil. This has been a huge interruption. So that has been part of it. And a lot of it, like I said, Mike, a lot of it has to do with it's a global sell-off, right? The sell-off deepened heading into the weekend as Brent crude compounded worries sparked by back-to-back U.S. inflation reports. We had wholesale and consumer inflation that came in higher. Along with wagers, the Fed will have to hike rates. Policy tightening bets are also gaining traction in Japan, where producer prices jumped by the most since 2014. Bond yields definitely feel like they're getting unhinged, according to blah, blah, blah. The market is not only testing the Fed, it's putting Congress on notice. The longer the interest rates remain high, financing costs go higher. And that's why I talked about that before already. Bond yields gradually moved higher in recent days. Sell-off gathered pace on Friday, with yields in Germany, Spain, Australia, and New Zealand also pushing higher. Investors are also beginning to sound the alarm bells that higher borrowing costs may even puncture the recent run-up in equities. The move higher in global bonds is a little unsettling. An extended and persistently high oil price could be the nail in the coffin for bonds. For U.S. inflation, the overwhelming risk facing the economy according to Fed Governor Michael Barr. The comments followed data this week that showed producer costs accelerating at the fastest pace since 2022. It's a complicated environment for incoming Fed Chair Kevin Warsh, who was narrowly confirmed this week by the Senate to lead the U.S. Central Bank. The path is now clear for Warsh to be sworn in soon after. Blah, blah, blah. Okay, so anyway, that's what it is, dude. And we've been saying that it's going to continue to get worse as it goes from here, and everything goes in momentum. So the momentum is now against us. There's no optimism that a deal is getting done. Hopefully we see something go that way next week, and it kind of opens that back up. You would think the other countries would now get involved. Well, I mean, get involved in what? What are they going to do? There's arguments on this, but what exactly are they going to do? Are we going to march an army in, a navy actually, to open the Strait of Hormuz? And how does that work? We're not currently in any military, we're not bombing, we're not doing anything. So what are they going to do? They've already voiced their concerns and opinions on this whole thing, and where it's going to go. And even if we did start bombing and everything, unless you open the Strait of Hormuz and make things safe, I don't know. I don't know that solves anything. But again, I'm not a politician. I don't have to deal with all this stuff, so it's not my job. I just have to report on it to you guys. So let me know what you're doing this weekend. It's Friday. What are you guys doing? I am going to do some honeydew list stuff. I'm feeling stronger 6 weeks out on the knee surgery. I don't think I showed you guys here. I went on Wednesday and I got my, did I show you guys my actual x-rays from the knee? They all look the same. It doesn't matter whose it is. One thing I did notice though, is that they did not put anything on the inside of my kneecap. And I didn't ask the doctor why not. I've seen pictures where they actually will put a piece inside the kneecap to rub on this. I don't have that. I don't know why, but this is what I've got in my leg now. And this little dark spot here is the polyethylene. I think it's polyethylene, the poly whateverylene that has this sliding on it. And this is the frontal view where it is and kind of how it's on there. And you can see it kind of sandwiched in there. That gives me a lot more to work with than what I had here, which was straight up bone on bone. And when you're talking about bone on bone, it wasn't just kidding. It was straight up bone on bone rubbing all the time. And so that's what I had. And that has now moved to that. And that's what I got now. So, but it's healing up. It feels good. So I'm glad about that. Elks Convention, very cool. Have fun with that, Mike. I don't know where St. Marie is, Sault Ste. Marie. And Randy, I'll have to Google the Quigley Down Under. Oh, okay. You sent me a link. Cool. All right. I'll have to look. Are We Lost? A clip from Quigley Down Under. I'll look at it. Robo Hammer. Yeah, dude. Well, that's only my knee. Don't forget that I also have all the stuff in my leg. That was, I have all the metal there. So last few years, I've gotten a lot of replacement and repairable parts. So, but you can still go through the metal detector at the airport, which is kind of funny. So, all right, my friends. Well, again, sorry to bring you bad news. Hopefully we get through this and I'll chat with you guys on Monday. Make it a fantastic day, even though all the other stuff sucks. You could choose to make it a good day. Just, stay positive. All right. I'll see you guys later. Bye.